American Airlines Group, ticker symbol AAL, is currently trading at $11.51 a share. It is down almost 14% from the start of the year. And if we look at the 5-year chart, this stock was hammered since the pandemic. Previously trading at around about $28 a share, dropped down to $9, and has been on a pretty wild ride since then. So what we're going to be doing is looking at the stock, seeing if this can get up to those pre-2020 levels, and then going to my automated stock valuation spreadsheet, seeing if it's a buy or sell using discounted free cash flow model, comparable company model, and the Ben Graham formula for intrinsic value. So let's get straight into it. If we put in the ticker AAL, what this will do is it will load all the latest company financial data, and we can have a deeper look. So as I said, $11 a share, market cap of 7.6 billion, PE not profitable at the minute, minus net income as we can see here. This is in the trailing 12 months, so it is down. With the market average being around about 30 at the minute, it doesn't really matter as this is not profitable currently. Earnings per share minus minus 26 cents, and a beta of 0.45, meaning it is a lot more volatile than the market. Analysts saying it is a slight buy with a target price of $11.65. They do not pay a dividend, so we'll be not looking at the dividend discount model. Revenue for American Airlines is up to all-time highs actually in the trailing 12 months, 51.6 billion, beating out every other year. As you can see here, dropped massively in 2020 due to the pandemic. Strong rebound, and then continued and sort of continuing along that same trajectory if this little blip didn't happen. Net income, historically all over the place. Now, yes, they normally are a profitable company somewhere in the region of 1 billion. Minus 8.8 billion in 2022. We're able to be profitable again in 2023 with 820 million, but negative in the trailing 12 months. Free cash flow, very similar story, minus 1.81 billion. Sorry, minus 801 million, my mistake. Shares outstanding, they have not issued or bought back shares in the last 3 years. You can see they were aggressively buying back shares before that time from 2014 to 2019. Things happened in the pandemic years, and then they have been pretty consistent at that time. Sorry, I need a drink. As you can tell, I've got a bit of a cold. So let's have a look at the, I hope this is the right number, if it's $4,000 a share. No, this is the discounted free cash flow model. This is a way of valuing companies, looking at their expected future free cash flows and discounting them to today's value. Now, this is because of these negative free cash flow numbers. It's all over the place. Revenue growth rate, we're saying about 18%, with 61 and 72 billion in the coming years. Apologies. Let's see what Google is saying. Sorry, Yahoo. 53 and 56 billion, so that is a lot lower. In terms of growth, over the next 5 years, very high growth actually, 42%. Wow, I wasn't expecting that. But yeah, so they're expecting 50 billion in those coming years. So we'll actually bring that down quite a bit. We'll take an average of the prior to, which is about 4.5%. We'll go 5. We'll go 5. Net income margins currently minus 12%. What we will do is take an average of the last 3, which is around about 0.5% there. And then free cash flow, I mean, 60% is probably the more valued number there. $1 a share, wow, okay. So what would we have to do to see that be a bit more? Yep, no, discounted free cash flow says the stock is not a buy. Even with sort of generous numbers here, it's still saying it's not a buy. Right, guys, if you're interested, please check my Patreon. Links are in the description. But let's go on to my favorite. Well, actually, before we do that, I think the Ben Graham formula for intrinsic value, actually, you usually would like this. It looks at earnings per share, P of growth company versus AAA corporate bond. Currently 4.68%. But even with the growth of 45% or whatever it was, because of its, what was it, 45%? 42%, but because of the negative earnings per share, it is negative here. So if it was, I don't know, let's just say if it was $1, then it would be a massive buy. So somewhere in the region of The current share price is $11. It would need realistically about, yeah, somewhere in the region of 30 cents earnings per share. Now let's look at my final model, which is the comparable company model. This is a way of valuing companies, looking at companies of similar sizes, industries, and values. So some that immediately jump to mind when comparing American Airlines, I think it's Delta, ticker DAL. And what this will do is it'll load the company's financial data for these competitors. UAL, which is United Airlines, and LUV, Southwest. So, enterprise values, you can see there. Actually, what was the other one I wanted to look at? It was JetBlue share price. Ticker JBlue, who would have guessed it? Let's see if they're a bit bigger in terms of enterprise value. No, fine. We'll go with the other ones. It was just because that they have an enterprise value of 37 billion. These were all quite close. Delta is the largest, 51. American Airlines 37, United 35, and Southwest about 18. Revenue all pretty similar. 50, 59, 54. Growth rate all growing, which is good. Delta is the highest, so maybe I should have a look at this. And they are profitable. Very high profit margins compared to these two, 7%. So what we'll do now is we look at the certain metrics. We have profit margins. Delta and United are the highest, Southwest next. This is the only one that's not profitable, as you can see here. Southwest barely profitable, 77 million. Delta and United with 4.5 and 2.9 respectively. Price to sales, average of the market currently is 3, and all of these companies are 0.1 to 0.7. Price to book doesn't have a value for American Airlines. PEG, which is Peter Lynch's price to earning growth, all over the place here, 0.3, which means very, very undervalued according to that. And then Delta is incredibly high, which is interesting because of the other metrics here. It does look the company in the best shape. EV to revenue, EV to EBITDA, and PE. Now, unfortunately, we cannot do PE because of the fact that American Airlines is not profitable. So we can take some averages on there. For EV to EBITDA, it's actually got a price of $40 a share. EV to revenue, it looks about fairly valued at 13. So quite interesting. If we compare the companies in terms of, let's do it here. And if we put in the ticker of AAL, Delta, UAL, United, and finally LUV, Southwest. This is over the last 5 years. So you can see American Airlines was hit the hardest, down 55% compared to Delta's 8%. That's because they have grown in the meantime. Actually, we'll go over the year to date firstly. Only American Airlines is down. Delta, United, Southwest, all up. United Airlines being the highest. Over the last year, once again, similar stories. United and Delta pretty neck and neck. And then over the last 5 years, you can see they're all down. So I think it might be interesting to look at either Delta or United, do a comparison, because they do look a bit more interesting than American Airlines at the moment. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Sorry, I'm a little bit under the weather. Check out my Patreon as well if you want my automated stock valuation spreadsheet. And I'll catch you guys next time.